As Danny mentioned, my name is Sarah Syed. I'm a private equity reporter here and have been covering sponsor coverage for about a decade. It's never a dull day. Before we kick off, I'd like to give my panelists the option, 30-second elevator pitch.
I exited off that side and I was like, ugh, I'm gonna have to walk in front of everyone, so I'm just walking around.
We've still got a mic on. This happens on TV all the time. Luckily, we're not broadcasting live, so it's fine. Nikos, if you want to kick off.
Sure. Thank you for having me here. I'm Nikos Stathopoulos. I'm a partner and a member of the executive committee of BC Partners, which is responsible for the leadership and the management of the firm. I've been in private equity for 22 years, and I'm very pleased to be here today.
I'm Karen McCormick. I'm the Chief Investment Officer for a firm called Beringea. We tend to do more early stage growth capital than later stage PE. We have about $700 million under management. And I've been doing this for not quite as illustrious career, but about 13 years.
Thanks. Good afternoon. I'm Jonathan Mussellwhite. I head the European private equity practice for OMERS, the Ontario Municipal Employees Retirement Scheme. So we're a $100 billion Canadian pension fund with around 15% of our assets in private equity today.
So following on from Morgan's presentation about fundraising, data shows that large firms had announced fundraising targets collectively exceeding about $300 billion at the end of 2018. And 2019 has been pretty good for fundraising so far as well. We've seen some massive funds close from the likes of Permira and Cinven and Advent. I won't name names, but I think a firm on this panel might be looking to fundraise next year, Nikos. I'd like to kick off this panel by asking you what it is about the institutional investors that still love to put their capital into private equity. Karen, do we want to kick off with you?
Yeah, sure. I mean, I think it has depended on the market cycle. And in this market cycle, it's a good place to put money. I mean, I think you guys have probably heard today, and we've had the conversation about things are expensive right now. But as long as interest rates are very low and there aren't other great options, we're still making quite a decent return. Maybe not as much as we made from the vintage years of 2009, 10, 11, but we're still making strong returns. And I think for us, we've had basically the same investors for nearly 30 years now. And we have half of our funds in traditional LP GP structures and half in retail high net worth structures. Our redemption rate on the high net worth side is less than 1% a year. And on the LP GP side, we've literally had the same LPs now for almost 30 years. So I think if you have a good track record and you've got a good relationship and you're a trusted source, it's a relatively easy decision for the LPs.
Nikos?
I think simply put, it's the fact that the returns in private equity are superior to other asset classes, and they are consistently so. So if you're an investor and you want to invest in various different asset classes, private equity is an obvious one, despite its illiquidity, which actually, by the way, it's been fixed in some creative ways as this industry evolves. But despite the illiquidity, you see that our returns are superior and consistently so for more than 3 decades now.
Jonathan?
Well, I mean, we have the advantage in so much that we don't have to go out and fundraise. But if I think about the way OMERS works, we invest across the private asset class, which for us would include private equity, infrastructure, and real estate. And I think, both my two colleagues here have said that it comes down to returns. We're operating in a very competitive market today. From an OMERS perspective, there's still a very heavy appetite to put capital towards private equity. It's still the outperforming asset class relative to the others. So while we may be seeing return compression today, we're seeing that across the privates, whether it's a real estate, whether it's infrastructure. So private equity still continues to outperform. So from a balanced return portfolio perspective, I think there's still a lot of demand for that return.
So that's the key part of this, isn't it? It's the returns. I mean, LPs, institutional investors, are very attracted by the high double-digit returns that this asset class is offering, which is probably why we're seeing a lot of these sovereign wealth funds and these pension funds look to team up with the likes of yourselves to do either co-investment or direct investment. But before I kind of dig deeper into that, we've got a poll question. And I don't want you guys to leave me hanging, so I need you guys to get your phones out, open up the apps and answer the question that we've got coming up. So the question is, will co-investors like sovereign wealth funds and pension funds switch to direct investing and compete with sponsors? So you've got three options there. Yes, this will happen soon, maybe in the long term. No, most will prefer to stay as non-control investors. All right, what's happening? 53, 52. Oh. Okay. Oh, we're getting a lot of audience participation. That's good. Thank you. You're not all asleep. Can you guys see the results? Okay, so we've got, in answer to the question, yes, this will happen soon. It's changing slightly. About 48% of the audience are saying, yes, this will happen soon. How many of you are LPs? 1, 2, 3, 4. How many of you are direct investing? Okay. All right, so we've got 49% saying, yes, this will happen soon. Does that surprise you, Jonathan?
Well, it doesn't sat where I sit because we made that switch in sort of the mid-2000s. And the reason OMERS made that switch, and we're probably at the extreme of the Canadian pension funds because we are a pure direct control position investor. We will do minorities now, but essentially we're a direct investor. And we switched for one very simple reason, which was returns. We did the financial analysis and we looked at the sort of the 400 to 600 basis points of leakage that you suffer as an LP. And took the view that we could do it ourselves. It's been a long journey. It's not easy to do. And I think that to some extent we probably timed it quite well in sort of 2004, 2005 to make that switch. I think it would be a lot harder to do today. But again, it comes down to can you put that capital to work and can you generate the return? And for us, it was a very easy decision to make.
I just want to come back to that. I mean, well, firstly, I mean, do the results of the poll surprise you and Karen? How do you feel about what the audience is thinking?
I would say yes, a bit, in the sense that I don't believe this will happen soon. I think there is a difference between willingness to compete direct and ability to do so. And I think there might be willingness out there from some of our LPs. But as Jonathan also highlighted, it's not an easy thing to do. It's not impossible, but it's not easy. And it's not easy for a few reasons based on my experience. Firstly, it's the ability to retain and to attract and retain talent is absolutely key. And I think the structure of the LPs, or most of the LPs have, is very different to the one that private equity has, which means also the incentives that potentially most LPs can offer to executives are very different to the ones that we can do. I think secondly, this is really a long-term business. It takes 10 to 15 years, in my experience on average, to have somebody that you say, I trust him or her to lead a deal based on a track record, unsupervised, and with the credibility and the trust that it's required in order to pull the trigger and have that conviction to make that investment. So it takes time. And that is not by accident that it takes time. This is very much a judgment business, hence why you don't see many LPs doing it direct. Thirdly, you need the infrastructure. It's not just about the willingness to do it. You want to have the ability to have potentially an operations team in order to support your investments. It's not just about sourcing a transaction, which many people can do, and potentially if you have the network, you can do it. It's also, in my mind, the question, what do you do with the asset once you bought it? It's about not only being the right sort of sourcer of an asset, but being the right owner of an asset. And these things take time. So will it happen? Maybe it might happen, but I think the people who decide to do it, they also have an opportunity cost. They need to think about what does it mean for my other GP relationships? Because that means that if you compete with me as a GP, indirectly, you might influence negative my returns that I will make in the fund. It may also mean that if I was planning to give you co-invest, I will think potentially twice of doing so, and I will give my co-investment opportunity to an LP who's not necessarily willing to compete with me. So there are more implications in doing so. I think the willingness itself, which I'm sure it's growing given the returns of this asset class, does not necessarily translate into action.
How do you feel about the results of the poll, Karen?
Yeah, it's not surprising. I sit in a different place, I think, than Nikos, but for us, this already happened, and it happened once in a false start, and it's happening again in a more professional start. And I think after 2000, so we do early stage growth capital. Check sizes for us around $20 million would be a reasonable first check for us. In 2008-9, I think what we saw was a lot of, not so much the sovereign wealth funds, but the pension funds, the multifamily offices, see their investments fall off of a cliff and say, you know what, if we're being eroded by frictional costs and we're not making money anyway, why don't we do this ourselves? And so we did see in 2009, 10, 11, we saw quite a few of them trying to go it alone. And then realizing it's actually very difficult. And they were skewing the market for us for a little while. They were people that were co-investing with us, that were investors to us, and that were competing with us. And it was skewing the market for a while, not necessarily always on pricing, but often on pricing, but also on underlying structures, because doing a deal isn't just about here's the money and the price. There's a lot that goes into the kind of the controls, the corporate governance, the what happens after the deal, et cetera. And so I think there was a period of a couple of years where we saw, it wasn't flooding the market, but we certainly saw more direct competition from some of the people who had been LPs for us or would have been LPs for us. After a couple of years, I think that changed quite a bit in that they either decided, actually this is harder than we realized, and we need to put real money in it and professionalize, or actually we're going to continue to do some of this, but more under the co-invest umbrella, where they would prefer to follow, to allow us to do the kind of deal sourcing, structuring, investment, corporate governance, and maintenance, but could we come along with you? And in that situation, we'll be flexible with how the money is used, kind of how easy it is to draw it down, et cetera. And so I think it happened once, and then it became much more professionalized, and we see it with, we were talking about kind of OMERS Ventures earlier, which is a bit earlier stage than us, but we would potentially both co-invest and compete, while OMERS would potentially be an LP. So we do see it happening already.
So I do wonder when I speak to sponsors and I ask them this, about 5 years ago, 6 years ago, it was about, how do you feel about the Canadians coming in? And now it's a question of how do you feel about the Middle East money coming in? And, when you do these big conferences, there's one in particular that I go to every year, and I think most of the industry does. And as I said, 5, 6 years ago, it was the Canadian money running around. This year, it was the Middle Eastern money running around. And, you mentioned earlier saying that when you, as OMERS, entered this direct space, it was a different market. Why do you think it would be difficult now for the sovereign wealth funds and the pension funds to do what you did back then?
I think it's partly a matter of scale. So when OMERS made the switch back in call it 2005, we were probably, so it was pre my time, but 50 billion, maybe slightly less. So if you're then trying to make a meaningful move into private equity, the numbers sort of work. As you start to get much larger, to be relevant within the scheme, trying to put that money to work as a direct control position investor, just the deal flow you have to generate is huge. And as Nikos rightly says, it takes time to build credibility. It takes time to build maturity of team. People is the hardest thing. So if you're going to go out to the market today to build a team who can meaningfully deploy large sums of capital, that's a very difficult thing to do. It's a very expensive thing to do. But it's also a very difficult thing to do today in the back of a bull market where everybody is well invested, they're well into their incentive schemes. Times may change. If I look back to the OMERS experience, we opened in London and we opened in New York in 2009. So we also took the opportunity off the back of the GFC to go, okay, this is probably an interesting time to go in. So I think scale is one of the big challenges today.
To play devil's advocate, you could argue that a lot of these sovereign wealth funds and pension funds are building scale, are getting to know the talent within your business and your asset class whilst they co-invest with you. So how do you know, or if I was to sit here and say, I think that the sponsors are being complacent by saying, you know what, they don't have the scale. But, we see the likes of Adia co-investing with EQT on 10 billion ticket deals with Nestlé Skin Health. We see them teaming up on big deals like ThyssenKrupp, which are $15 billion tickets. What is stopping them from getting this talent or the research or the knowledge to then become more than co-investors?
Are we being complacent, first of all? I don't think we are, because we are working on a growing industry. So I would almost say we're fortunate from that perspective that we are practitioners in an industry that's growing. You saw the data that before that your colleagues were sharing. And in an industry like this, actually, there is the ability to have various business models. And I think our industry can accommodate various business models. Do I think that we'll see some of the big guys like Adia or some others potentially competing directly with us? Maybe. It will happen. My point is that if you are an LP, today you have multiple touch points with your GP. You can be a fund investor, you can be a co-investor, you can also potentially buy minority stakes into the portfolio companies of your GP. So you already have multiple ways of making a return. And in some cases, and a higher return that you would have expected just by investing in the fund, do you really need to go direct? Which, to John's point, it requires additional resources, it requires time, it requires investment. Some people may make that decision and say, yes, I want to also go direct. I think the also is the operative word here, because I think eventually you will realize, like in the case, I suspect, of OMERS, which is more of the outlier in the industry, but they made the decision to do it many years ago, that it's going to be difficult to be able to do everything. Because if you compete with a GP directly, and at the same time you go to the GP and say, I want to invest in your fund, and by the way, dear GP, please give me some co-investment next time you make an investment, well, something's going to give. So it's a conscious decision. People need to understand, if you go that route, it's unlikely they're going to have the cake and eat it.
Let's talk about these nuances. I mean, how many awkward conversations do you have with your co-invest or with your LPs, and you go to them and say, hey, we would love to co-invest with you on deal X, and they say, thank you, but we don't think that you're our best partner for this. We're going to go with your competitor. Have you had awkward conversations?
Absolutely. Absolutely. It doesn't happen every day, but there is a scenario where you do approach an LP and you say, we're having a very large transaction. Would you be interested in co-investing alongside us? And thankfully, I can say in most cases the answer is yes, but there are scenarios where the LP will say, I'm sorry, I've been asked already by another fund, and they test what really sort of the probability of you winning this deal is. And we cannot be always the winners on transactions. So they say, what is your angle in this transaction? What is your industry expertise? And so they make a judgment call themselves on whether I think you have a bigger chance to invest. We don't take it personally.
I've heard of an instance where a sponsor has said to an LP, thank you, but no thank you. We don't want you to invest in our fund anymore because of a situation like this. They didn't co-invest together. Have you heard of instances like this, or do you think that they're uncalled for, and is it kind of playground tactics? Does it cause for real awkwardness, when you're out there fundraising potentially? Karen?
We haven't had quite the same awkwardness, but I think the dynamics in our industry are different. It's far less likely that you'll have a single LP who's backed multiple horses who are going to be bidding for the same asset. And we don't bid for assets, we invest in growth capital. So I think the dynamics are a little bit different, and there's also much more room to syndicate. We don't necessarily need to have a single investor in a particular deal. And I mean, on the retail side, it's interesting for us, because we have a number of kind of very high net worth investors. And for them, they're never going to kind of circumvent us and just do a lot of what we do on their own, but they're very interested in the co-investing and the follow-on. And in some instances, we'll have LPs that have different points of view on things we're investing in. So we've made an investment in an esports company. If you don't know what esports is, it's think Real Madrid, but instead of playing football, they play video games as sports. Absolutely massive industry. Some of our very high net worth or multifamily offices absolutely love it, desperate for us to do more and actually want to do more directly. And then there are others that have a very different opinion about it, and who either just don't get it or see it as, I don't want my kids or grandkids playing video games in the basement. And so in those circumstances, that's probably where we almost see a little bit more conflict than necessarily the reverse, where somebody's trying to back another horse to bid for the same thing.
You raise a good point. I mean, I guess we have to differentiate between the kind of pockets of private capital that's around. So it's not just the sovereign wealth funds, it's not just the pension plans, but it's the family offices as well, which have significant amounts of capital, and we see them doing direct investments as well. What do you think of the emergence of family offices doing quite significant deals in spaces that you also might operate? Jonathan?
And I think that for us has probably been the most noticeable change over the last 24 to 36 months. And indeed, we've had a number of opportunities, that come to mind this year in North America, where both of the bidders were family offices. One that had very limited exposure historically to private equity, but had decided that this was an asset class that they wanted to be in terms of this opportunity, and they went there. And again, for me, without wishing to sound like a broken record, it slightly comes back to the scale point for me. When you compare the size of some of my peers in the Canadian pension industry, they're 200-300 billion, 2-3 times the size of OMERS. Family offices tend to be more in the 10 to 20 or 5 to 20 billion. So it's more possible to be relevant through a direct program when that's your scale, as opposed to if you're 300 billion. If you're 300 billion, you're just not going to build a meaningful private equity practice by only doing direct. So you have to be an LP. And then you get into some of the challenges that we've talked about here. But I think that those family offices are definitely that's the newer class that we're seeing.
Let's talk about slowdown. You know, there's a lot of chatter about a correction in the market. We're not quite sure what it's going to be, a hike in interest rate, just general growth slowdown, recession. You know, how do, you know, you're a different beast because you've been through a cycle, but,
Yep.
you know, family offices and sovereign wealth funds and pension plans that may not necessarily have been through a downturn, how do they react when they are control investors? You know, do you think that we will see a retrenchment of these investors in an instance like a recession? Karen?
Yes.
Easy.
I mean, the whole industry is systemically overpaying for everything. In cases where you've been doing it for a very long time, I think you can be more savvy about underlying structures, potential upside returns, making bigger bets on the things that you feel you're going to make money on. I mean, we turn down so many deals right now that we absolutely love just because we can't see ourselves making money on the exit. And it used to be that when you were investing in a growth deal, the multiples that you were paying would be discounted to the large public company market multiples. It's the reverse now, where for growth deals, I mean, the growth multiples are generally higher than the market multiple, than the public market multiples, which is just insane to me. It's a buy high, sell low strategy. So it just doesn't make sense. And a lot of the people that we tend to lose those deals to are people who have been in the market for less than 7 to 10 years. That's almost always who we're losing to. So I definitely think there is going to be a little bit of a reckoning, hopefully not one that has such significant impacts that it really impacts the industry as a whole. But yes, there are going to be people who kind of are new to the game and find it's a lot more difficult when the market turns.
Nikos?
The benefit of investing behind a GP at the end of the day instead of directly, I think to Karen's point, which you haven't had the experience, is as a GP, you've seen several cycles. And if you've been in the industry for a long time, and we are actually investing, private equity is a cyclical industry itself, ourselves, we do go through cycles. If you've seen this, you've built experience. By having experience, you build discipline. And that discipline eventually, I think, prevents you from hopefully making mistakes. And we are in the risk business, so eventually we're probably going to make a mistake or two. But that discipline is key. The way I think our industry has managed to do this, and I think it's the right to do it, frankly, is if you assume that we cannot time the market and we don't know when the downturn is going to come, the way to address it is by pacing our investments. So if we stage our investments over the years at the same roughly pace, and we not only just invest, but also look at to exiting our investments, then hopefully you're not going to face that issue. But it's true that, as in every industry, when you have a bull market or people think that this industry is growing and people are making money, they pile in. And they say, I can do the same job, and I will also be able to make money until something goes wrong. And that's the differentiating factor with people who have been it, and they have the infrastructure, the team, the network, the track record, and the experience, and those who actually have the money and the goodwill to actually to perform.
I think the problem is compounded in that if you're new to the industry, and a lot of these guys are pretty new to the industry, you have to pay more to win the deal because you don't have the track record, the brand, the reputation, the network, et cetera. Sorry.
Well, I mean, valuations are sky high. That's probably another half an hour panel. But you know, this idea, does that mean where we might see people make mistakes, those that have less experience and less downturn experience, does that mean more opportunities for the more experienced investors like yourselves?
Over the long term, I think yes. I think and Nikos touched to this earlier in terms of sort of structure. You know, a lot of people will say, well, if you're a permanent capital vehicle, sovereign wealth, family office, a Canadian pension fund, you have the advantage of being able to ride the cycle over the longer term. There's no false time horizon around a fundraising cycle that forces you to make decisions. And to a large extent, that's true. But as we all know, time is the enemy of an IRR and return. So actually, this isn't just about being able to hold it longer, it's also being able to manage that asset longer. And I think one of the things that the GP community does very well, and we have replicated within OMERS, is building that operational capability. It's not just about getting the deal, it's about what you do with that business. And I think that when you go into a down cycle, that's what really separates parties, is to how they manage those assets. Because you're invested in the business. There's no way out. There's no quick exit. So you need to work. It's time consuming. It requires experience. It requires knowledge. And that, I think, is a real segmentation point in terms of what follows. So I don't think you don't see the benefits day one, but I think over the medium to long term you do. And you're possibly better placed to continue to have that confidence to invest through the cycle, including when that dip comes out, than those who maybe are struggling with assets that are problem children.
Are you having to work harder on your portfolio companies? Obviously, I want to touch on this very briefly, but when we're talking about kind of valuations going through the roof, I mean, are you having to work even harder with your portfolio companies to kind of extract the value? You know, if you're paying higher multiples on the entry, you want to make sure that your exit multiple is worst or best case scenario, at least the entry multiple or higher. Are you working harder with your portfolio companies to get that alpha?
The short answer is yes, because by definition, when you invest in a high valuation environment, you need to make sure that you exit with an asset that's bigger and better than the one you bought, and you buy growth. So our focus, at least the way we're addressing this, is yes, the valuations are high. By the way, the valuations have been high for a few years now, so we could have had exactly the same conversation 3-4 years ago about lots of dry powder that I saw on the chart, about high valuation stuff. It's deja vu for everything that we discuss. And it goes to show of the job of our GP, the job of our investor, is to continue investing and finding these pockets of excellence, finding these pockets of deals, finding these industries or subsectors that we think are going to make money. But yes, we're working harder. I think for us, part of the exercise is the asset selection. So you need to buy the right company. And the right company has to have certain, in our book, regardless of sector, key characteristics as being market leader, have strong cash generation, have multiple levers of growth. And I think what we've increasingly experienced in a very high valuation environment is that you cannot be investing in a one-trick pony. You should be investing in companies that you can have multiple levers of growth, a lot of this optionality, and optionality both in terms of how you grow, but optionality about your exit route at the end. And making the assumption that you can still generate returns without assuming that at exit you will exit the same multiple that you entered. Because we all assume that this environment is going to stop. I don't necessarily think we're going to see a crash. I don't see us that this environment is going to stop very short term, as long as interest rates are low, as long as the earnings of the companies are good, as long as you can find these pockets. But our job has become harder, hence why becoming a better owner of the asset, not just the right person on selecting the right asset, but becoming the owner of the asset through the operations group, through having the discipline, through structuring more on sector and becoming more deep sector expertise, through a variety of ways in our industry has become key.
I'm very conscious of time. The timer here, you can't see it, but it's changed from quite a sobering white to quite an aggressive yellow. So I think I'm being told to wrap up. I think I'm going a bit rogue here, but I would like to open the floor to questions if anyone has any for the panel. I take that as a good sign that we answered all the raging questions that you may have had on this topic. So I'd like to thank my esteemed panelists for joining us here today. Thank you.
You're welcome.